Good evening and welcome to today's webinar. We have an interesting topic today, which is introduction to reinsurance concepts. So some of you, many of you who've joined uh, right now may not be handling the reinsurance function as such, the way we're seeing the registration forms. But nevertheless, this session will be like an eye opener for all of you, where uh, it will give you a basic insight into what reinsurance is, what is the scope of reinsurance, what are the needs for reinsurance, and what is the fundamental concept of reinsurance, in which way it helps insurance companies to manage their business, right? So we all understand the context of insurance. First step is insurance. What is insurance? Insurance is pooling of risks, sharing of risks of this people who are exposed to similar set of risk. Now, reinsurance is an outer circle to insurance, where it is a pooling of risks that are assumed by the insurance companies. So you could say that insurance is pooling of risk of customers, and you could say reinsurance is pooling of risk of insurers. So it's a second layer of sharing of risk. It's a second layer of pooling of risk. So this way, the concept of reinsurance is something like spreading the risk even further, right? So when we say insurance itself, what does it mean? We are trying to spread the risk of a few people who may have a loss with the contribution made by many others who will join the insurance agreement. So when you say spreading of risk, what happens to the insurance company? They also keep giving insurance protection, and they also accumulate risk. So it is very important for them to manage their business, that they in turn spread the risk through the process of reinsurance. So in simple words, if you were to define reinsurance, it is nothing but insurance of insurance, right? So uh, we will go through a few slides which will give you further breakdown of what I'm saying right now. But I wanted to fundamentally understand the definition for reinsurance, right? It is a further spread of risk that the insurance company assumes, accepts. This is very important, especially for the private companies and also for the public sector companies, where the risk is very, very huge. Without the backup of reinsurance, in case there is a huge loss, then they may have to stick their neck out. It becomes very, very difficult for insurance companies to handle large claims, right? So they have to necessarily have an insurance program. It is a very regulated environment in India. Every insurance company has to maintain a certain, very effective reinsurance program. uh, the entire efficiency or the entire financial strength of an insurance company will depend on how effective their reinsurance program is, right? So, like, there are many people who, insurance companies, who are rated based on their reinsurance companies. See, for example, if we take one private general insurance company, let's take the example of, let's say, HDFC Ergo. So their insurance company, they have the insurance business. Now they in turn take reinsurance for their risks, right? So reinsurance for their business means it will be for each line of business. Like they have a reinsurance arrangement for their fire business. They have a reinsurance arrangement for their marine business. They have a reinsurance arrangement for their miscellaneous business. So in turn, when they do reinsurance, they will also reinsure with some standard and high rated reinsurance companies. So the credibility or the rating of an insurance company also depends upon the credibility and financial status of their reinsurance company with whom they have their tie-ups. So whenever in property, especially when an insurance company is going out to source property business, which is fire, or business interruption, industrial all risk. So the end client, which is, let's say, a manufacturing company, they will always ask, what is your insurance setup? So the insurance company will generally present their strengths by saying, yes, we are backed by Scor Re or Swiss Re or Munich Re or GIC itself, which is the National Reinsurance Company. So, like this, highly rated and financially stable reinsurance companies will in turn protect the risk of the insurance company. So, this is a very detailed program. But today in this session, we will look at some of the basic idea about what reinsurance is and how useful it is for an insurance company. So in simple definition, again to repeat, insurance of insurance. That's what insurance is, right? We call it insurance of insurance, right? So the person, in the case of a reinsurance contract, the insurance company becomes the reinsured, right? Like how we say insured, insurer. In the case of reinsurance contract, we say reinsured, reinsurer. That's the difference. So the reinsured, which is insurance company, is also called the ceding company because they cede their risk. What is to cede? Cede means they transfer. They transfer a portion of their risk to the reinsurer. So they are called the ceding company. And of course, the reinsurer is called the reinsurance company. Right? These are certain basic terminologies and a basic definition for reinsurance. So right now we'll just go through a very simple presentation which will give you some insights, quick insights about what reinsurance means. So right now, like we saw, reinsurance concept. See, even when we spoke about insurance, we know that it is built on the concept of law of large numbers. What is law of large numbers? It is about spreading the risk to a lot of larger group, right? So that the uncertainty becomes more and more certain. I don't know how many of you have attended our risk management or our basic principles program, where we discuss about the theory of probability. Theory of probability, law of large numbers. When we say insurance, we're talking about probability. There's no surety that the claim may occur, the claim may not occur, right? It is an uncertainty. But how do you handle that uncertainty? How do you handle or manage the risk of uncertainty? Only by spreading the risk to a large platform, right? So when you have a larger platform who share the risk, who spread the risk, then the uncertainty becomes more and more certain. And in this way, we're able to manage the portfolios much more effectively. So when you say one vehicle, whether it will meet with an accident or not, 50-50 chance. But when you say 100 vehicles, you have a certain historical data, law of large numbers. There's a trend. You can say that out of 100 vehicles, 10 vehicles will meet with an accident. So your uncertainty of 50-50 becomes a 10% certainty. This is the concept based on which insurance is built, based on which reinsurance is also built. So uncertainty of a few becomes certainty of many. This is what the concept of law of large numbers. So there's a greater accuracy in predicting the number of losses that may occur. And also we can predict the size of loss. Depending on the historical data, depending on the claims trend for larger group, you will not only be able to predict the number of losses, but you will also be able to predict accurately the quantum of losses, the average size of loss. So especially when you talk about catastrophe, like I said in the beginning, why reinsurance is important? Because every insurance company will want to protect their balance sheet when there is a large claim. Let us say a flood or an earthquake or the terrorism that happened in the Taj Hotel. The claims run to a few hundreds of crores. So if they have to pay that big a loss, then they may just wipe out their balance sheet. So very important that they have a reinsurance program for their entire line of business so that they get back recoveries, right? They get back the protection from the reinsurance company. So catastrophes require a different understanding of incidence of losses and over a large number of risks. So it's very important that we follow the concept of law of large numbers, and to manage catastrophe, reinsurance becomes a very important tool. Reinsurance hinges on the concept of spreading the risk over large numbers, larger geographies. So one thing is large number of clients, large number of stakeholders, larger geographies. When you talk about reinsurance, most of the reinsurance companies will spread overseas, right? Not just Indian market. Many insurance companies in India, they will have the primary reinsurance agreement with GIC, but they will also have foreign reinsurers on board. So, which means the risk is getting spread over larger geography beyond India, right? That is how you can dilute the risk and you can manage the risk and you can have a a certainty about the loss that may or may not happen. So just to give you a brief preview about reinsurance in India, right? So the nationalization, of course, happened in the year 1973. But before 1973, if you just see the history of reinsurance in India, in 1956, Indian Reinsurance Corporation was formed. It was called Indian Reinsurance Corporation. In 1961, the first concept or the first contract of reinsurance was introduced, which was a compulsory cession. When I say cession, I told you, right? Ceding company. A compulsory transfer of risk from the insurance company to the reinsurance company was introduced in the year 1961, where all the insurance companies in India at that time would reinsure a portion of their business with Indian Reinsurance Corporation. This was the first type or method of reinsurance that was practiced in India. Of course, in 1966, we had something called a fire and hull insurance pool. So one of the ideas, one thing is to do reinsurance with the insurance companies, but there is also a very famous method or concept of reinsurance called the pool. We have the third party pool, we have the terrorism pool. In 1966, we had something called a fire and hull insurance pool. Right now, it's not the after nationalization, it was dissolved. But that was one of the first initial types of reinsurance that was practiced in India. Now, then we talk about nationalization, which happened in 1973. What do you mean by nationalization? All the 108 insurance companies that were operating in India came together and got merged into 4 public sector insurance companies, right? So they were called the general insurance companies, which we know right now are National India, Oriental, and United India. So the nationalization happened in the year 1973 for the insurance companies. At that time, when the nationalization happened for insurance companies in 1973, post the nationalization, GIC became the national reinsurer, Indian reinsurer. The name Indian Reinsurance Corporation was changed to General Insurance Corporation. So GIC handled all the reinsurance contracts, all the reinsurance arrangements within India. So there are a few key terminologies like facultative and treaty in reinsurance. We'll talk about it in the next slide. So both facultative and treaty, all the reinsurance arrangements within India started getting handled by GIC post nationalization. So, and then we talk about liberalization. What is liberalization? In the year 2000, we know that again privatization came back, right? So the public sector got demystified, and then the entire liberalization happened in the year December 2000. So the 4 subsidiaries of GIC were demerged and they became independent. And GIC operated, it still continues to be the single reinsurance company in India, but many private companies started coming into existence which were licensed by IRDA. So primarily GIC became the only reinsurance company for all the 4 public sector as well as the newly emerged private companies. All the companies would first offer their business for reinsurance with GIC. In case GIC is not willing to give the reinsurance protection, only then they can approach a foreign reinsurance company for a reinsurance protection. So right now we will look at some of the functions of reinsurance. So we saw the definition, we saw the history of reinsurance. Right now, why reinsurance? We saw it briefly when we spoke initially, but right now this slide is very useful. So one thing is increased capacity. When we say increased capacity, what do you mean by capacity? It is the financial capacity for an insurance company to accept more business. See, only when you have a backup support, you can freely expand your business to new products, to new geographies, to new lines of business, to higher value of risk, right? Increasing capacity means you are insuring capacity, like a company like HDFC or ICICI, or even for that matter, your public sector companies, if they have a strong reinsurance setup, then they can venture into new business. Like if you know, you'll be very clearly aware, there's a whole liability insurance vertical within every insurance company. Now, if you want to freely do product liability, public liability, or because it's a very specialized product, and when the claim comes, it comes very big, isn't it? Liability. So, unless you have a proper insurance protection, you cannot freely do these products. You cannot freely market these products. So, it increases the capacity of the insurance company to introduce new products, to go for large risks, and to venture into new geographical areas. The second function is financial stability. Like I said, every corporate which insures, every reasonable corporate will always ask the insurance company, who is your insurer? What is their financial rating? We call it CRISIL rating or credit rating or S&P rating. So the financial rating or the credibility, credit rating of the insurance company, the reinsurance company is very important for any corporate, that they will evaluate before placing business, especially property, right? Because they want to be sure that tomorrow if there's a claim of, let's say, 100 crore, 200 crore, they want to be sure that they will get the claim from the insurance company. So it functions in terms of giving financial stability to the insurance company, and it stabilizes the claims ratio. So because whether you have large claim or small claim, as long as for a particular line of business you have reinsurance, you keep getting back claims in a certain percentage. So, like, the reinsurance is designed either on a percentage basis or on a limit basis, right? Or on a multiple, number of times. How, let's say, you retain an X amount, and then you have a 10-line treaty, 12-line treaty. Like this, are very many methods of reinsurance. Whichever way it is, whichever method you choose, if you have an annual arrangement, you keep getting back claims from the reinsurer also. Once you pay the claim to the insured, you get back the reinsurance from the insurer. So it stabilizes the claims ratio of the insurance company in a very, very definite way, right? And accumulation of claims under different classes. One other thing, very big problem for insurance companies nowadays, we're seeing how many new classes are getting introduced, right? In property itself, if you see, there is something, there are some new classes like foreign debris clause or intellectual proprietary value clause, designation of property clause, and new coverages. After AV rates have come, almost all add-ons are being given up to a level of 5 crores. So all these add-ons and classes, they bring in accumulation of big losses. If there is one loss also, it wipes out the portfolio of the insurance company. So this kind of accumulation also can be taken care by reinsurance. Once you're backed by reinsurance, then there's a constant financial support whenever you have sudden losses, whenever you have new type of losses where you don't have prior experience how to handle it, right? And a very important function is also spread of risk. Like I already said, it spreads the risk with more insurers and reinsurers. It also spreads the risks over wider markets, insurance markets, not only within India, but outside India as well. And solvency margins. See, like I said, very important from the client point of view, they will look at your credibility. And from the regulator point of view, IRDA, they have stipulated minimum solvency margins for every insurance company. It has to be 1.5. What is solvency margin? It is a asset to liability ratio. Always your asset should be 1.5 times more than the liability. This is prescribed and regulated by IRDA. Why? Because only if a person, if an insurance company has 50% more assets than what they are liable for, they will be in a position to pay out the claims to their clients. So reinsurance also helps in maintaining and protecting the solvency margin that is required by the insurance companies. It stabilizes profitability. Once you have projected what is the worst loss that you may have and you have sufficiently reinsured, you also tend to make small margin of profits as an insurance company. So this is a whole scientific approach where how a reinsurance program is designed is the work of experts, right? And mm, to arrive at a certain few terminologies like probable maximum loss, or let's say even in terms of setting your retentions, in terms of setting how much you want to reinsure, all this will also be targeted towards achieving a certain minimum profitability, right? So it stabilizes profitability in a very consistent way. And there are a few other functions like, it enables an insurer to consider unusual proposal. So when we talk about something called facultative reinsurance, it is a reinsurance which is very unique, where you are accepting a very unique proposal. Let's say an event insurance, a marriage wedding of some huge celebrity, or an insurance company has got a proposal to cover a huge cultural event or a political event. It is one of its kind, right? It's a very unusual proposal, right? Let's say a cricket match, right? Or a cultural event or a religious event. So all these, the sum insured or liability amounts will run to crores. It's a very unusual proposal. You may have a claim, you may not have a claim. So all these also, without the support of reinsurance, an insurance company will not be able to venture into it. So what they do is they take one by one such proposals, take it to the reinsurance market, place it to a few reinsurance companies, and enter into a policy agreement. So it enables the insurers to consider unusual proposals. It may also provide the insurers benefit of their expertise. So when you have reinsurance backing, they have their insurance expertise, they have their international market intelligence, or their expertise in terms of handling claims, difficult claims. All that also comes to use to the insurance company. So let's say you have a loss of profit business interruption claim. If you have a reinsurance, they will suggest, they will guide based on their international experience. Lot of expertise pooling happens when you have a strong reinsurance setup, right? So expertise is a huge game. And reinsurance also helps to absorb newer risk exposures. Like I already said, because of the pandemic right now, there's so many new risks that are emerging. I was talking to some people on the other day about the marine insurance, which is exploding in terms of new risks because of the lockdown situation or the backlogs in terms of logistics. Uh, you know, uh, the warehousing that is happening, it's all beyond the control of all the stakeholders, right? So all these new risks. So when you have, your marine transit shipment that is stuck in a warehouse for much longer period than you expected, it has its own risk, right? Like this, there are so many new risks that are emerging in every line of business. Like nobody even spoke about foreign debris until 3 years ago, but after lockdown, this has become a huge need. Right? What if debris flows from the neighboring compound to mine? Nobody thought of this risk. It's a new risk. So for all these also, if you have a reinsurance protection, the insurance company can absorb such new risks very easily. It is a means of communication. So definitely, like I said, the insurance company will always like to project and promote the backup strength of their insurance in every communication that they give out to their customers and to the market. So right now, just to summarize what we spoke. So insurance is a transfer of a part of it. Insurer transfers a part of his risk with a reinsurer to manage their risk and business. This is what reinsurance is, right? Again, like how, in the case of the insured to insurer, it is full transfer mostly. But in the case of reinsurance, it is a portion of the risk that gets reinsured by the insurance company with the reinsurer. That portion of the risk can be in a particular line of business, it can be in a particular proposal, right? It differs from case to case basis. The reinsurer is the one who accepts the risk. Reinsured is the direct insurer who cedes the risk, who transfers the risk. These are key terminologies. Reinsured is the person who pays the premium to the reinsurer. So let's say, the arrangement of reinsurance something like 80-20, which means the reinsured, that means the direct insurance company, has decided to keep 80% within myself. Okay, if there is a claim for 100 rupees, 80 rupees I'll be able to pay, but 20 rupees I want from the reinsurance company. So it's a clear 80-20 arrangement. So accordingly, if let's say the premium is 100 rupees, which the primary client is paying to the insurance company, 80 rupees will be retained by the insurance company, 20 rupees premium will be paid to the reinsurance company as reinsurance premium, right? So that is the certain proportion. Like we already saw, insurer transfers a certain proportion of their risk. So let's say 20% they decide to reinsure. Then out of 100 rupees, they have to send 20 rupees to the reinsurer. And let's say there's a claim of 1 lakh that happens, they will get back 20,000 claim also from the reinsurance company. And similarly, like I said, the reinsurer agrees to pay a proportion of the loss occurring under policies issued by the reinsurer. This is a very, very simple thing. 80-20 is something that's very, very simple because it's an introductory session we're talking. There are much more aspects to designing a reinsurance program. But right now, the simplest way, this is something that we call as a quota share treaty, right? So quota share arrangement. Quota, that means what? 80% my quota, 20% reinsurance quota. So premium also 80% mine, 20% reinsurer. Claim also 80% I will pay, 20% reinsurer will pay. This is specified quota, right? A limit that is set as a percentage. So there's a proportion as that is set. So this is simply called like a proportional reinsurance arrangement, or in other words, it's also called as a quota share arrangement. Right? So another important feature in reinsurance is whenever a reinsured, which means a direct insurance company, transfers a certain amount of risk to the reinsurer, let's say 20 rupees he has given away as premium in the example that I shared, he will also get back commission, which is called RA commission. I'm not sure if how many of you attended our Insurance for Beginners course where we spoke about the financial framework of insurance, where, one of the important revenues for an insurance company is also reinsurance commission. So as an insurance company, I pay commission to my agents, but I get back reinsurance commission on the reinsurance program that I enter with the reinsurer. That is a source of revenue for me. Right? On the 20 rupees, I may get back 2 rupees or 3 rupees based on whatever is being decided for that particular contract. Okay? So here, because like how you pay agency commission to a third party in the case of a primary contract, here the insurance company itself, which is the reinsurer, they will get the RA commission. Though you may have a reinsurance broker, they may get a brokerage. But the unique thing about reinsurance is there is always an RA commission that is involved that will be received by the insured or the reinsured, which is very important. This is being paid mainly to meet the management expenses and acquisition costs. Because see, the entire primary business, everything is handled by the insurance company. The reinsurer comes into play only to pay the claim. So a lot of effort goes in issuing the policy, sourcing the business, Everything is being done by the direct insurance company. For that, they get some RA commission. Most reinsurance contracts are transacted through an intermediary called a reinsurance broker. So unlike insurance, where you have direct sale also, B2C also happens, isn't it? Any client can go to the website of the insurance company and buy a motor policy or a health policy or even a travel policy, nowadays even fire policy. But in the case of reinsurance, mostly there is always a broker involved. Between the reinsured and the reinsurer, there is always a reinsurance broker who will be involved in terms of intermediating the terms, conditions, and the placement of the reinsurance contract. So this summarizes what reinsurance is all about. So I think this I will skip, but just I want to leave you with one picture which is very, very useful for you. You could take a picture of this. So just to summarize, in our detailed program, we do cover, about how these reinsurance methods apply, what are the detailed analysis of how these programs are designed. But right now, I want you to get a picture of this. Like I already used these two famous words, which is facultative and treaty. So when you talk about reinsurance concept, we already spoke about how it applies and how it works. But when you talk about the reinsurance methods or the types of reinsurance or forms of reinsurance, we have two broad categories, which is facultative and treaty. And within facultative and treaty, both you have pro rata, which is proportional and non-proportional arrangements. So in a very simple term, proportional is something like I said, I used the example of 80-20. There's a clear-cut proportion. This is mine, this is yours. Right? In both facultative and treaty, you have both proportional and non-proportional is something it is not based on a definite proportion. It is random. It is based on a loss limit. It is based on a loss ratio limit. Like this, there are many methods, many types of reinsurance that we may discuss in our detailed course. So another important feature about facultative and treaty is the main difference between facultative and treaty is facultative is a reinsurance arrangement made on a case-to-case basis for each and every proposal, because it is an unusual proposal, or maybe because it's a very large proposal, like I said, a political event or a marriage event or a unique type of liability policy, or a very loaded coverage. Some of these factories, they take something called a mega policy, right? So that a mega policy is not a standard policy. It has all unique coverages clubbed into it. So if you have one such policy, you may not be able to place it on a regular basis. You have to place it as a special basis. So like this, facultative is one-on-one placement. Each proposal has to be evaluated, submitted by the reinsured, and the reinsurance company will evaluate and arrive at the terms. But when you say treaty, it is a regular arrangement for generally 1 year. So every insurance company will have a treaty for 1 full year, where it is an automatic arrangement of reinsurance. So treaty is what we have for a particular line of business, right? So every insurance company or the reinsured will have treaty for each line of business, which is like an automatic arrangement. You don't have to run to the reinsurer for every fire policy. When you have fire LOB, fire line of business treaty, all the policies that that particular insurance company issues will get automatically reinsured into the fire treaty. So it's a regular automatic arrangement. This much I wanted to get. These are some of the keywords that you need to know as far as reinsurance is concerned. So just to summarize, so we know who's the reinsured, who's otherwise called a ceding company. We know who's the reinsurer. We know the post and pre-nationalization history of reinsurance in India. And we also understood the law of large numbers and spread of risk, not only within India, but outside India as a spread across geography, and how reinsurance actually increases the capacity and the financial stability of an insurance company. And we also saw certain basic terminologies like facultative and treaty. and how the premium and claims are shared between the reinsured and the reinsurer. So this is, like I said, a very introductory session. Nevertheless, I'm sure it helped you get some idea about reinsurance. But I would encourage you to enroll for our detailed program, which is, I think, coming up in this month itself, which is, which will deal with all that we spoke right now in much greater detail. It will help you navigate through your clients as well as your insurance companies, to be able to speak about reinsurance with much more clarity and understanding. So right now I'd like to stop here. Thank you so much for some of you who've been very, very regular with our free webinars. Thank you so much for joining us. And I would encourage you to continue and make use of the free webinars. And if you feel you found it useful, very important that you spread the word with your friends who may find it useful as well. Right? Thank you so much. And I think right now we'll stop it here and we'll meet you again soon in our next webinar. Thank you.